Sustainability, in its simplest terms, is about meeting the needs of the present without compromising the ability of future generations to meet their needs. That's the definition that we're using. Hi, I'm 𝗟𝗓𝗓 𝗦𝗂𝗧, and I am the head of APAC for Qblue Balanced. Welcome to the session today. I'm just going to run through a few key housekeeping points. So the session today is going to cover an innovative approach to sustainable investing, which I think you're going to really enjoy. I'm just going to give a quick introduction to Qblue Balanced and �𝗂𝗓𝗓 𝗦𝗂𝗧, our key speaker. �𝗂𝗓𝗓 will give a short presentation, and then we will have a fireside chat following that to delve into some of the ideas that we bring up during the session. Then following that, we will have an open session with questions from the audience, so make sure you stick around for that. There is a questions box available for you, so if at any point during the session you have a question, just pop it in that box and we will 100% come back to it later, but I don't want you to forget your questions as we're going through some of the technical details. So let's begin then. Qblue Balanced is an asset management firm based in Copenhagen that was launched in 2018. They are systematic and sustainable in their approach, and they invest in public market investments. Currently, the firm has 2.3 billion euros assets under management, with 3 strategies, 2 that are live and launched. One is the Liquid Alternatives Multi-Strategy. The second one is the Global Sustainable Leaders, which is a long-only global equity fund. And the third is that will be launched in Q1 is a Global Climate Transition Investment Grade Credit Fund. Long name, but a very important product. More interestingly though, please allow me to introduce our speaker, CEO founder 𝗂𝗓𝗓 𝗦𝗂𝗧. So to a lot of you out there, he would be very recognizable, particularly those from Europe and the Americas, but perhaps less so in the rest of the world. So I just give a few points that may be of interest. So he doesn't look like it, but he's had a 30-year career in the financial markets with positions in the Danish Central Bank and the Ministry of Finance. Probably the most relevant roles that we would talk to and reference today will be the 2 CIO roles, so Chief Investment Officer roles, that he held at 2 of the largest pension plans in the world. The first one was ATP, which he joined in 1999 to build out their business. That is the largest pension plan in Denmark and the 3rd largest pension plan in Europe. And then subsequently, after a few more things on notches on his belt or feathers in his cap, he was asked to be the Chief Investment Officer at 𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏𝗏 So obviously two big jobs and very different and rich experiences. And it was really through these experiences that he identified and was able to see that companies that added societal value in many different ways across the spectrum had a greater chance of success, because countries and people want them to succeed because they're adding value. So that means that sustainable practices mean that a company should be sustained into the future. However, how do you identify these companies? And that's another topic altogether. So with that, I'd like to hand over to Bjarne to give us some insights into the work that he's done at Qblue, and then we can go into some more questions after that.
Thank you very much, Alex. I appreciate the introduction. So before we go into the presentation here, I think I'll just tell you a short story about more or less an epiphany I got, and an epiphany that really has formed the basis for the view we have on sustainability today. So I started working with sustainability back when I joined ATP in '99, and started implementing a lot of different things there, integrating the sustainability aspects. We called it social responsible investments at the time, starting with the governance part, and then the social part, and then after that the environmental part. But for the first 10 years, it was mainly a focus of excluding certain companies and then more actually identifying the problematic companies and engaging with them. And it was really not until 2009 when we started doing renewable energy investments that we started to see that there was companies out there creating societal value that was interesting investment objectives. And I was like thinking about that for several years. How could we turn sustainability from being only about the bad companies destroying societal value and also about identifying the best ones that created a societal value. And my epiphany, I got that shortly after I joined Teachers. One day, the ambassador of Chile in Canada came to the teachers' offices and requested that the teachers participated in a large, I think there was like almost 2,000 people, a lunch for the president of Chile, Madame Bachelet, that was visiting Canada. And it ended up being me that participated, and arriving as a newcomer to Canada in a big like conference center, noticing that I was seated just across the table from the president. I was a little bit starstruck and not quite sure how come. So I asked the president, so why this honor? Why did you invite teachers to sit at your just next to you? And I noticed that the finance minister of Canada, he was like 8 seats down, so it was quite an experience for me at the time. She told me a story, and I think that story is really an important one. Teachers had huge investments in the water business in Chile. We were doing drinking water supply to households and also wastewater treatment in 2 of the 16 regions in Chile. And they had noticed, as we had built out the capacity, building reservoirs and fixing the leakage from the pipes, every household, even the poor families, had potable water and plentiful. And also after starting to do wastewater treatment, the infection diseases and infant mortalities in the 2 regions we were running had much less problems than anywhere else in Chile. And she told me that, we need foreign capital to help us build our society, and the investments you've done, the things you've done in Chile, that's really what we need from foreign investors. And I want to showcase that for the whole Canadian community, so everybody else can do what you did. And that's of course a great story and an experience for me. But I think the real interesting part of it was, because we created societal value, we started being granted a lot of new projects. We won the 𝗕𝗷𝗿𝗂𝗃, and really the business we had in Chile thrived, and we made a lot of money there. So I think that story was really my starting point for saying, well, it is actually possible. If you create societal value, you can identify projects where you help society solve some of their problems, and you get rewarded in the end. And that's really the basis for the Sustainability Cube and our approach to investment. So Qblue Balance was, as Alexandra said, founded in 2018, and relatively soon after launch, we started working on how can we help investors to solve their problems, not only by getting high risk-adjusted returns, because that is the main focus, but also on making sure that you do that in a sustainable way that will even enhance your returns going forward. If you turn to the next slide. So as Alex said, it's really about sustainability for us. It's about meeting the needs of the present without compromising the needs of the future generations. But I think the second bullet here, that recognizing that your contribution to society and societal value creation is instrumental, not only in how you're being assessed, but actually how your chances of making successful investments are. One good example of that is not a lot of people think about it, but actually the Inflation Reduction Act in the US is a good example of that. If you come to the US, create jobs in the US, and help the climate transition process, you get huge subsidies, and you get rewarded by doing so. And that is a trend that has becoming more and more clear to me in the past years that more and more governments around the globe is rewarding companies that create societal value defined in the way each country and each region think is the right way to define that. So for us, investing in innovation and in progress is very much about sustainable investments. It's not only about avoiding companies that are the problematic companies, but it's also about identifying the companies that are best positioned to benefit from the solving the big challenges. So we're doing that and recognizing that even though from time to time, as you see right now in the US, at least in part of the US, there might be some backlash to how you think about this. We do believe that this is one of the most powerful trends that we have seen in investments, and we do believe that's going to on a global base to accelerate in the decades to come. So the next slide, please. So just as a very simple concept, because one of the things that we realized soon when we started working with this was two things, that what sustainability is, or ESG investments, or social responsible investments, or whatever it's called, or no matter what people call it, often it's very ill defined and it's very ill measured. So we from the outset decided we needed a robust framework for thinking about this, and the framework is really a pretty simple economic term, because everybody that studied economics know that companies' activities are typically only measured as their GDP contribution. But in most textbooks, it's clear that if there are positive or negative externalities, the market will not solve the problems on its own. The externalities will have to be some way dealt with. If it's a positive externality, you would in some way need regulation or subsidies to help companies exploit those. And if you are destroying societal value, creating negative externalities, and thereby reducing societal value, you would need to regulate that either with taxes or regulation. So our approach is really to try and measure societal value, define it as creating societal value, but also measuring it by trying to find indicators that measure these externalities and identify companies that either destroy or increase societal value. So that's the approach. If you go to the next slide, please. So what we've done is creating a data-driven framework, a multi-dimensional framework. Multi-dimensional because creating societal value comes in many forms. You know, it can be if there are antitrust issues that you exploit a monopoly, you might be destroying societal value. If you create privacy problems with your business plan, you might be doing so. But if you enhance health, or if you enhance equality, or if you enhance climate transition, you might be creating societal value. So the multi-dimensional part is really important for two reasons. One is that, well, societal value is multidimensional. The other part is that the data you have on sustainability are, well, you can say characterized by three things. The data are short, they are incomplete, and they are noisy. So there's a lot of problems there. So we spent a lot of time buying data, cleaning data to make them more accurate, creating our own data and working with partners to create better data sets. So one thing is to cover as much of the societal value creation process as possible, but also to make sure that even if we have noisy signals in our definition, if you have a lot of signals covering the same topic and multiple topics, there's much better chance that you will end up not having the noise as a problem. If you take all your decisions on one data set, most of your process would probably be characterized by noise. So that is the cube, and the three dimensions we have defined is the ESG industry leaders score, as we call it. That's a broad measure of data in the E and the S and the G space, where we add it all together. There's a lot of data providers there. So we have worked with Sustainalytics, we have worked with ISS, we're mainly working with MSCI for the time being. But I think what characterizes the data is that they're all provided by the company, either by companies' web pages, companies' annual reports, or companies filling in questionnaires. And there tend to be a bias in the data set in the sense that large companies spend more resources on their web pages, their policies, their reporting, filling in questionnaires. So if you only use ESG data, you might end up giving an advantage to large companies. So we've been working with other dimensions as well, climate transition, and I think climate transition is a good example of, even within the 3 dimensions, you need to be cautious what you measure. So we think of all 3 dimensions as having 3 sub-dimensions. One is really how well is a company doing today? And in the climate transition, that could be things like actual emissions. But we also think that how they're positioned for the future is key, and how should you measure that in the climate transition dimension? Well, we use 2 different approaches. One is that the companies that are very strong on their reduction plans and have credible reduction plans, and I think the latter is really important because a lot of companies has net zero ambitions and have set goals, but sometimes that's the only thing they have done, set a goal for being aligned in 2050. And if they don't have interim goals, if they haven't shown so far that they have ability and willingness to actually start that process now, we don't give a lot of credit for having a net zero commitment if you do not have interim goals and you have shown in the past that you will follow your plans. So that's one part of the future on climate transition. The other part is as important. That is, we have spent a lot of time creating our proprietary data set on green innovation. And that is really companies that have technologies that are unique and that they can use to solve some of the big problems in the climate transition area. And we are using our proprietary patent data there, downloading millions of patents from all regions in the world, figuring out if they're green, which company they belong to, and then we have a measure of the most sustainable companies with the most innovation going on. Finally, the 3rd sub-dimension is perception. We wanted to create something that was not based on companies' own reporting, but on how a company is perceived by the broader professional public. So we worked with a Danish company called 𝗏𝗏 and did a joint venture to use machine learning to screen more than 100,000 web pages per day and train the algorithm to look for companies that was mentioned in relation to one of the 17 sustainable development goals, and like 2 of them, like 7 and 13, are very much in the climate transition space. So we count how many news stories are there that relates to the SDG number 7 and 13, and then we count if it's a neutral, negative, or positive story about the company, and the better perception a company has in the broad public, the more likely we think it is that they will actually be creating societal value. So that's the approach we use in all 3 dimensions. The 3rd dimension is measuring all 17 sustainable development goals by the UN and trying to figure out if a company is aligned or not. If you flip to the next slide. So here you see what I just talked about before, that we are data driven. We have full transparency in which data set we use. So it's not like we might not have the correct and right answer to everything and the best definition of everything, but at least the risk of us doing greenwashing is very low, in the sense that we have full transparency on which data we use, how we define sustainability, how we define climate transition, by showing people exactly the data we use. So you can see we use a lot of different data for actual emissions at the top, scope 1 and 2, per $1 million invested, per $1 million of sales. We use scope 3 data as well, and since the reported data is not always accurate, we use estimated data and reported data and combine them in the best possible way that might differ from industry to industry. We use, as I said, the carbon emission management data, as well as the green innovation data and the sentiment data. So if you flip to the, not the next page, but I think flip to the one with the SDG scores. Yes, this one, yes. So we do the same thing in all three dimensions. We try to find data that gives a good view of whether a company is creating societal value today, whether they are positioned to do so in the future, and how they are perceived by the public. And you can see in the SDG dimension, we have 5 data sets we use. 3 of them is data sets we have bought and improved, and 2 of them is data sets that are proprietary, we have created ourselves. So the first 3 is SDG revenues, how large a percentage of your revenue is aligned with the Sustainable Development Goal. The next one is how large a percentage of your product range is aligned with the Sustainable Development Goal. But also, and we think that's important, not only which product do you produce, but do you produce it in a way where you do not create negative externalities. So for example, a brewery might not necessarily have a product if they brew beer that is very well aligned with the SDGs, but if they use less water in the production, if they have less accidents on the working floor, if they recycle all their cans and bottles, they might have strong operational alignment, even though the product might not be aligned. And then again, here in the SDG, we have created a broader innovation score for like what we call grand societal challenges. There is a broader range of patterns that is related here. And we've created a separate innovation score that relates to all of the SDGs. And finally, we have sentiment data for all 17. On the innovation score, I would say that that's a quite interesting data set, since it's by far the longest data set we have. We have downloaded data back to 95, so we can actually test over a very long time horizon. Is it actually the case that companies with most innovation going on in the SDG space and the green innovation space performs better in the market than companies without innovation? And it turns out 2 interesting things. Companies with patents tend to perform better and return better returns over time, but also that companies with SDG patents or green patents, they perform better than companies with general patent or general innovation going on. So that was quite encouraging to see that that's one of the few data sets where we have enough data for a long enough period where we could actually backtest it. If you move to the next slide. So this is all great, so that we are able to, on a data-driven and multidimensional way, to integrate all these data into what we call the sustainability cube, where we add it all together and average over the 3 dimensions and measure which companies we think creates the most societal value and which might destroy societal value. And that's a very good starting point. And that approach, we have integrated that into all our products. But we are very aware that our purpose here is to create investments with high and attractive returns on a risk-adjusted basis. And therefore, if you just invested in companies with the best sustainability score, you might very well end up with a portfolio that you didn't like for return and performance reasons. So when we do portfolio construction, and this is just one example here from one of our products, this is the Global Sustainable Leaders product, a MSCI World long-only equity mandate. What we do is, of course, we do, as you can see on the slide here, we define the benchmark. We have a little bit more names than the benchmark. There's a lot of the companies just outside the benchmark that has a lot of interesting innovation going on. And then we do, in step 3 and 4, we get rid of some of the companies we don't want to look at. And that is either because they have very poor scores on the sustainability factors, so they get excluded, or, and that's number 4, and I think that's really key. We don't want to invest in companies that does not look attractively from a price perspective. We're using our factor scores that the team and the core team in Qblue Balanced is a team that work together. 6 of the 7 founders work together at ATP between 99 and 2017. And by having this lens that we only want to invest in sustainable companies if they are financially attractive, I think we create a much more robust framework for sustainable investments than people that are mainly focused on the sustainability angle. To give an example, when we started the fund here in 21, we had some solar companies as well as offshore wind companies, some of the leaders in their industries globally, as there was a strong tailwind for sustainable investment and green renewable energy investments in 21. It actually turned out that at the end of 21, we didn't find that the offshore wind companies was attractive anymore. So even though they were still the global leaders in offshore wind, we did sell them because we didn't find them attractive. And in the beginning of 24, we sold the last solar companies we had, the last solar company we had in the portfolio. So even though we're looking for the most sustainable companies across all industries, we currently do not have or have had any offshore wind or solar companies in the portfolio, not because they're not sustainable, they certainly are, but because we don't find them financially attractive. And then I should say, we have a very strong risk toolbox, and we've seen a lot of sustainable investments being so focused on finding the best companies that they end up having a very skewed portfolio in the sense that they have an overweight to Europe. There's most sustainable companies there if you compare across regions, but we have a balance between Asia, Pacific, Europe, and US. We don't want to use this to only look for the best companies in certain regions. We look in all regions, and we have also a process that will ensure that we look for companies in all industries. Even though it is difficult to find sustainable energy companies, we think it is important to participate in the transition and have companies also in energy or utilities. So it's a pretty robust portfolio, and the framework has worked really well. And I think our investment committee spent a lot of time up to the election, the presidential election in the US, considering how harmful it could be for a portfolio if there was a big change in the approach to sustainable investments or renewable energy investments in the US. But it turned out that our portfolio approach, where we have the risk factors and also the pricing factors as an integrated part, has been very helpful, and we continue to be very well positioned among the sustainable investors, and we have not been hurt by the last 2 months sell-off in renewable energy production. So that's an example of how we have integrated it. We have integrated the Sustainability Cube approach across all our products, depending on whether it's the multi-strat market neutral hedge fund, or it's the upcoming investment grade climate transition bond fund. It's always taken into consideration and implemented in the way we think it's most likely to be successful from an investment perspective. So with that, I hope it was a lot of information to digest. I guess you got here in the past presentation, but I hope it gave you an insight into our thinking and why this is a different approach to implementing sustainability into your portfolios. Thank you.
Thank you, Bjarne. That is, I mean, I learn something every time I hear that, and I must have heard it a lot of times by now. So, so sustainability. That's why I gave the definition when we started, because I think that the word has been used so much so that people don't even it doesn't, it's kind of lost some of the meaning. And there's also a lot of risk seen with it, and that's what we've seen from the backlash from in the US, I guess. So what makes this, I suppose, what do you think that other people are doing with ESG, and what makes this fund different? Or is there a standard that you think that most companies are doing, and what's different about the Qblue stuff?
Yeah, no, but I think the big problem with whether you call it sustainable investments or impact investments or ESG investments or social responsible investment is that it's so ill-defined. It has become more or less like emotional. If you say sustainable investment, some people they think woke. Some people that is harmful to societies. Really, that's probably what some people think. Some people think, well, we need to save the planet. But both those two statements would probably be more emotional than looking at the underlying data and fact and objectives. I think the industry, asset managers, everybody has really not done a good job on trying to define it in a way. I think the societal value definition that would probably make sense to most. You can probably ask every government: is it important that the companies that operate in your country helps creating societal value? I think that would probably be a statement that most people could agree on. Is less emotional. That's probably more. That's what we're trying to do. So, and then defining what societal value is. Is it societal value to create profit and jobs? Yes, it is, because that's the definition of GDP. So that's part of creating societal value. But if you, in addition, enhances health or educate young people because you train a lot of people, that's creating societal values. I think spending more time there. But then I do also think that the what you just say, what happened, let's take Europe. So EU decided that there was a lot of people doing greenwashing and doing a lot of things. So they made this taxonomy and templates for Article 8 funds, that is light green funds and dark green funds, Article 9. In some way they tried to solve a problem, but I do think that the asset management industry in some way has misused that, because in the beginning everybody just wanted to have an Article 8 and 9 fund, and what did they do? Well, they asked client, what do you like? So they started sometimes with not a strong belief in how they could create value, but what they thought the market wanted, and created products that might not be very strong product, but was easy to take to market. Some people went to their cellar and found some old bottles of wine and relabeled them. So they just took something they already did. And I think there's been a lot of, if not mis-selling, at least things done, give them what they want. Let's relabel it. So some people make the mistake, I think, that they were so focused on finding really global leaders that they ended up only investing in few industries like renewable energy or healthcare, and so they ended up with a portfolio that had huge financial risks. So I think I don't think the asset management industry has managed this really well. I think you're seeing a backlash right now on the green bonds part in the investment grade space, and I think green bonds is in a way a good thing, because it's tried to define that you finance projects that are viewed as they're being climate friendly. But now when I talk to CIOs and our clients, they have two objections to green bonds. One is, I'm not sure if I buy a green bond from a company that is still in general not green. I'm not sure if I will be accused of greenwashing. What if you take an energy company that opens up a lot of new oil fields and doesn't really comply with the Paris alignment, doesn't do any climate transition, but they have let's say a hydrogen project in the Gulf of Mexico? Is that something where you should be supporting a project if the company does not apply? And so that's one thing. The other thing is that people
follow the rules.
CIOs doesn't like it doesn't like to have 3 basis points lower returns on green bonds. So we said, well, this is it's a good innovation, but it's probably not the right way going forward. So we use the cube to identify companies that create societal value, and then we invest in their bonds, no matter whether it's a green bond or a blue bond or a red bond and so on. So I think the industry, it's not that I lack a standard, because I don't think there'll ever be a standard, but I think we need a vocabulary, we need the language where we can get a little bit of the emotions out of our discussions and make it a little bit more fact-based and data-driven and well-defined. I think that would be helpful.
Okay, so then talking about the data. So there's, as you said, there's a lot of data. There's a lot of incomplete data. There's a lot of noise. So how do you actually get all of this data and put it together? Because I think that that's one of the key things that people struggle with. How do you get the data and compare apples to apples so you can implement it? So yeah,
Well,
how does that work?
Well, I think there's, of course, I think there's three key things. One thing is of course about the definition. You want to be multidimensional. You want to be measuring today as well as the future. So there is some conceptual things you need to get right, because then you know where you would be looking for data. So that's number one. The other thing is like all our people are very strong on technical skills and data, big data and so on. So one thing is a pure noise thing, that if you have one data set where most of the data is noise, let's say 80% of your signal is noise and only 20% is the right signal, then if you use that signal, you are absolutely not sure if it works, because most of what you base your decisions on would be noise. But if you take 20 incomplete noisy signals and you add them together, then it actually turns out that most of the noise cancel out, and you have 80% signal now and only 20% noise. So just adding a lot of data from a statistical perspective that is not correlated helps you a lot. And then I think the final thing is that how do you deal with it? We spent a lot of time. We have people working, we have one person working full-time on this, and several persons working with creating new data. We form partnerships, so having the resources to create your own data and work with partners to create better data, that has been part of our strategy as well. So it's a lot of work, but in many aspects.
And you said you used data from a bunch of different sources, right? So adding those together is what
that is key,
I suppose
yeah.
is not repeatable. So no matter, even if you tell everybody this is how we do it, no one else can do it, because they can't do it in the same way, essentially.
They can't do it in the same way, no. And I think especially the machine learning sentiment data and the pattern data, of course, we have downloaded all the patterns, but one thing is getting tens of millions of patent data into your database, but what to do with them and how to take those inputs and create a signal. Just one small thing I can tell you on the patent data. I don't know if you have seen patent data, but there is who owns the patent, who has invented this innovation, and sometimes it's a company name, but it's not an ISIN code, so you have to translate it. The patent could say IBM or IBM Corp or Corp Dot or International Business Machines or whatever, but the first thing you have to translate a lot of different options into this ISIN code for International Business Machines Corporation in the US. There could be spelling mistakes. Another thing is that what we realized was some of the car producers, they didn't have any green patents, and we couldn't really figure out why until we realized that we were only looking for the listed company in the databases, and we needed to take their subsidiaries into account. So we had to download full legal structures for 20,000 companies. So even the subsidiary of Renault that holds a patent was counted as a green innovation. So yes, you can replicate it if you decide to spend a lot of time and have really smart people that are good at data science to work with your data set. So it is doable, but you would really have to spend time and resources doing so. And you couldn't replicate exact what we're doing, but you could probably do something like it if you really had a lot of people working on this.
So then that takes me to another point. So with all of this data and how quickly information moves, what inefficiencies, because obviously exploiting inefficiencies is how you make money. What inefficiencies are you trying to exploit?
Yeah, so I think that's a really good question. So one of the things that we did find is that when you get data from data providers on let's say ESG issues or so on, or often there's a huge lag between something happening and the ISS, the Sustainalytics, MSCIs of the world update their data set. The one thing is that, for example, the climate transition data, they come in slowly and not at the same time. But so often there's like a 9 months time lag from data arriving until you get an upgraded data set. So what we did find was that these sentiment data, where you screen all the online media on a daily basis, so we get the only data set we have a daily update where you get new information every day is the sentiment data. But often when something happens, for example, there was a Canadian bank that was involved in mis-selling of products in the US. It was picked up by the media, and the sentiment data turned negative on the company. But it took like 6 to 9 months before there was a change in their rating from the data
Interesting.
providers. So there is like an opportunity to collect some of the information before it's reflected in data, and I think that's an inefficiency that we can see. We can take advantage of, that we can get some signals earlier than when you get them from the data providers. I see we are starting to get questions on the question log, so maybe we should
Yes,
have a look.
we can jump over to that. So it says, as I understand it, the Qblue model utilizes novel data set in model building and portfolio construction, like the data from Matter. How do you ensure that these data sets are not too correlated with the existing ones that you use?
That's a really good question. So we as I said, since we have all these smart statisticians and data scientists working for us, that's something that we do on like a monthly basis. We test the correlations between all our data sets, and of course it's since we have maybe like 35 data sets or so, it would take too long to go into all the correlations between all 35. But what we do, where it's easy to do, is that if you take the 3 dimensions, there is different data sets in them: the ESG data set, the climate transition data set, and the sustainable development data set. Most people said to me when I started, so isn't there a big chance that since the E in ESG is environmental and it has climate changes, climate transition as well, that there will be a correlation between the two? And we tested that, and it turns out the correlation between the climate transition data set, the ESG data set, and the SDG data set is 0. I actually received an updated data set yesterday, and it is still the case that they are very different. They measure different approaches, and maybe it's not that difficult to understand, but because if you remember, or if you know how some of the data providers do their E, it is not only climate transition, it's also waste management, water, it's pollution, besides from climate transition. And then a lot of the E in the ESG is only measured, that's the approach for many companies. They say, is this relevant for this industry? So for example, in the information technology industry, it is not a big part of the data or the weight you get from the data providers, but we do think it is important for the information technology sector. So we have same weight in our climate transition in all sectors. So it turns out that the approach is actually quite orthogonal to each other, and we are constantly surveying. If we end up having data sets that are too correlated, then we would just merge them together, or well, then one of them might be just excluded, and we would select one of the best ones.
Excellent, thank you. So another question from the listeners. Energy and electricity and lack thereof seems to be an imminent issue globally. How does Qblue invest into the energy transition And
Yeah.
if so, how? Does Qblue invest into the energy transition? If so, how?
I think, yeah, we do, and it is a topic that is sometimes almost emotional as well, in the sense that some people has this strong view that you can't do anything if you want to be an Article 9 and want to be a sustainable fund. You are not allowed to invest in anything that has to do with fossil fuel, for example. That's not the way we approach it. So we do recognize that if we take an example, Danish company 𝗏, that was an oil and gas exploration company owned by the Danish government, was sold and taken IPO'd, what is that, 10 years ago or more. They have transitioned themselves into being 100% renewable energy company now. And our approach is really that we want to be looking for utilities and energy companies while they are still 𝗏, but have decided to become 𝗏sted, and not invest in them when they are 𝗏sted, where there's a risk that it's already priced in. So we are looking for companies across all industries, also the oil and gas, if we have some exclusions, but if you have a very strong climate transition plan, and if you have decided to move forward on that transition, we could be investing there. We don't have any oil and gas exploration companies right now, but we do have one of the companies in the oil and gas industry that has most innovation going on and has most technology and innovation to help the oil and gas industry to reduce their emissions. That's 𝗕𝗷𝗿𝗄𝗏, a US oil servicing company, and it's something that it's always discussed. Can you have a company like that? But we do think we need to be present in the energy space and figure out which company is best positioned to help doing the transition. So, but I would say in general, we do look for all renewable energy options and other options. We do test whether the Amazons and the Microsoft of the world, if they use green power to fuel their huge and growing electricity power demand. So it's a big topic when we score companies across all industries, how they manage the energy consumption and the transition there.
So then just one final question, and it's a good one to end the session on. So where do you see the best opportunities related to asset classes or industries in sustainable investing going into 2025? So what's your outlook?
I think one thing that we have seen over the years, or since we started doing this, is really that sometimes it's from the most surprising places that you find really strong companies, the boring places. You know, if you look at if you, for example, look at US retailers, that's not what people would think about as an area where you would find sustainable companies, and they are less sustainable than the European ones, if you compare there. But there's still somebody in the US markets that are the best ones, and we can see that we've had 𝗕𝗷𝗿𝗂𝗃, we've had Home Depot, not companies that you would think of as creating societal value or sustainable companies, but I think that approach that you look in Asia, in Asia Pacific, Australia, or New Zealand as well, you look for companies in Europe, you look in the US, and you look in all industries. So I think instead of only going with the hyped high impact, very easy to understand that this must be a sustainable company, but be looking for the leaders across regions and across industries. I think that's the winning strategy. So some of the more boring company in traditional industries that actually does a really good job, that's probably what you should be doing, instead of chasing the darlings that everybody that works with sustainability loves to invest in.
Excellent. So, well, thank you very much for all of the insights. As I said, again, every time I listen to you talk, I learn more, which is good. So thank you, everybody, for listening. We will be able to, we will share the presentation afterwards with you. And if you want to send it on to anyone else, that's also fine. And just reach out if you have any questions.
Thank you.
Thanks so much.